Hello and welcome to this week's lecture. This week we will talk about fundamental approaches and methodologies used to model and measure risk in financial markets and investment portfolios. So in our previous sessions we discussed data and its importance in AI applications. Today we build upon that foundation to explore how we can actually quantify and model risk using various mathematical and statistical approaches. These risk modeling techniques form the backbone of modern financial decision-making and are essential for anyone working in risk management, portfolio optimization, or financial AI applications. Understanding these approaches is key because risk is essentially part of every financial decision, and our ability to measure, model, and predict risk directly impacts investment outcomes and business success. So, let's begin by establishing a fundamental understanding of what risk management entails and why measuring risk is so critical. Risk management is fundamentally the analysis of an investment's return compared to its risk, with the expectation that a greater degree of risk should be compensated by a higher expected return. This is one of the most basic principles in finance, the risk-return trade-off. So think about it. If you're going to take more risk, you expect to be rewarded with higher potential returns. For example, when you invest in a stable government bond, you expect lower returns because the risk is minimal. On the other hand, when you invest in a startup company stock, you expect the potential for much higher returns to compensate for the significantly higher risk of loss. Risk, or the probability of a loss, can be measured using statistical methods that serves as historical predictors of investment risk and volatility. The key word here is statistical. We use mathematical and data-driven approaches to quantify what might otherwise seem like abstract concepts. These statistical methods allow us to move beyond gut feelings or subjective assessments of risk. Instead, we can create objective, measurable, and comparable risk metrics that help inform investment decisions and portfolio construction strategies. Now let's examine the commonly used statistical risk measures that form the toolkit of modern risk management professionals. The techniques we'll cover today include standard deviation, which measure the volatility or dispersion of returns, the Sharpe ratio, which measures risk-adjusted returns, beta, which measures systematic risk relative to the market, value at risk or VAR, which estimates potential losses, R squared, which measures how much of an asset's movement can be explained by market movement, various asset pricing models that help determine fair values for given investments, and the loss distribution approach, which is particularly important for operational risk. It's very important to understand that beta, standard deviations, and VAR all measure risk, but they do so in fundamentally different ways. Think of them as different lenses through which we can view and understand risk. Standard deviation looks at historical volatility, beta focuses on market-related risk, and VAR estimates potential future losses under normal market conditions. Each technique has its strengths and limitations, and professional risk managers typically use multiple approaches to get a comprehensive view of the risks they're managing. This multifaceted approach helps avoid the pitfalls of relying on any single risk measure. Let's dive deeper into our risk measure. First measure we're going to use is the standard deviation. Before we discuss the calculation of the standard deviation, we need to understand what we're actually measuring. The total risk in any investment is composed of two fundamental components: systematic risk and unsystematic risk. This decomposition is crucial for understanding how different risks affect our investments and how we might manage them. The total risk on a single asset or a portfolio is represented by the standard deviation, denoted by the Greek letter sigma. So we can express this relationship as total risk sigma equals systematic risk plus unsystematic risk. Understanding this decomposition is vital because these two types of risk behave very differently and require different management strategies. Systematic risk affects the entire market and can't be eliminated through diversification. On the other hand, unsystematic risk is specific to individual companies or sectors and can be reduced through proper diversification. This framework helps us understand why diversification works and why it has limits. You can diversify away unsystematic risk, but systematic risk will always remain. It's a risk that comes with participating in the market itself. So systematic risk is the risk associated with overall market. It's a risk that affects every security in the market, and it is both unpredictable and undiversifiable. You can diversify it away. So let's give an example. Political upheaval represents a systematic risk that can affect an entire financial sectors, such as the bonds, stocks, and currency markets. When there is political instability in a major economy, it doesn't just affect one economy or one industry, it affects everything. So all securities within these sectors would be adversely impacted because investors become generally more risk averse and uncertainty increases across all markets. Other examples of systematic risk include changes in interest rates set by the central banks, inflation rates, economic recessions, or major geopolitical events like wars or pandemics. These are microeconomic factors that influence the entire financial system. The key characteristic of systematic risk is that it can't be eliminated through diversification. No matter how well diversified your portfolio is, you can't escape systematic risk because it affects all assets in the market to some degree. However, systematic risk can be mitigated through hedging. To hedge means to take an offsetting position in an asset or investment that reduces the price risk of an existing position. Essentially, it's a trade made with the purpose of reducing the risk of adverse price movement in another asset. For example, if you own stocks, you might buy put options or invest in bonds that tend to perform well when stocks perform poorly. Unsystematic risk, on the other hand, is a risk specifically associated with a company or sector. This type of risk is called specific risk, or idiosyncratic risk, or diversifiable risk, exactly because it can be mitigated through asset diversification. Think of unsystematic risk as the risk that comes from factors specific to individual companies or industries. For example, if a pharmaceutical company's key drug fails clinical trials, that's unsystematic risk. It affects only that company and perhaps other companies in similar drug development, but it doesn't affect the entire market. Other examples include management changes, labor strikes at a specific company, product recalls, competitive threats to a particular industry, or regulatory changes that affect only certain sectors. A technology company might face unsystematic risk from rapid technological changes, while an oil company might face unsystematic risk from environmental regulation. The important point here is that this risk is only inherent to a specific stock or industry, and every security has a different level of unsystematic risk. A stable utility company will have much lower unsystematic risk than a biotech startup. The beauty of unsystematic risk is that it can be significantly reduced through diversification. By holding many different stocks across different industries and sectors, the unsystematic risks tend to cancel each other out. When one company has problems, others in your portfolio may perform well.